Hi guys, welcome to our FXPesa webinars. Today we'll be handling advanced one and I'll be taking you through fundamental analysis. So, fundamental analysis. This involves looking at the market by analyzing economic, social and political forces that affect the supply and demand of an asset. Like any commodity, the value of a currency rises and falls in response to the forces of demand and supply in the market. Today, we are going to be going through several economic factors which you can follow to identify economic trends and the effect on the currencies. The supply and demand of a country's money is reflected in its foreign exchange rate, and everyone needs to spend, and consumer spending directly affects the money supply. On the first fundamental analysis, we look at interest rates. Interest rates are probably the biggest factor in determining the value of a perceived currency. An anticipated interest rate hike by the central banks will usually cause a currency to appreciate, and an anticipated fall in interest rates usually causes the currency to depreciate. The base interest rate, or rather the nominal rate from the central banks, is what influences currency price fluctuations. And the global money is always looking to shift from countries with lower rates to countries with higher rates for the highest returns. 2. Inflation. Inflation is a steady increase in prices of goods and services, and it is presented as the Consumer Price Index, or rather the CPI in the economic calendar. It is generally accepted that moderate inflation comes with economic growth, but for advanced economies, the optimal rate of inflation is expected to be 2 to 3%. One of the biggest influences of central banks' interest rate decision is the price stability, or rather the inflation. 3. Monetary policy. When it comes to monetary policy, the national government and their corresponding central bank authorities formulate monetary policy to achieve certain economic mandates or goals. And it usually boils down to promoting and maintaining price stability and economic growth. As seen, to achieve their goals, central banks use monetary policy mainly to control the following: A. The interest rates tied to the cost of money. B. The rise in inflation. C. The money supply in the economy. D. Reserve requirements over commercial banks. And the discount window lending to commercial banks by the central bank. Balance of payments. When it comes to balance of payments, balance of trade measures the ratio of exports to imports for a given economy, and a country's current account reflects balance of trade and earnings on foreign investment. When explaining balance of trade, this is how we do it. Exports should always be greater than imports. This equals to a trade surplus and a positive trade balance. But also, if imports are more than exports, this means that the country is importing more than it is exporting. Hence, there is a trade deficit, which fosters a negative trade balance. A negative trade balance causes a country's currency to weaken as they spend more on importing goods than they earn through sale of exports. Conversely, a positive trade balance of payments tends to be favorable to the country's economy, hence earning more money. Hawkish and dovish central banks. Central banks, like most businesses, have a governor, president, or a chairman. His role is to be the voice of that central bank, conveying to the market which direction monetary policy is headed. Central bank speeches have a way of inciting a market response, and the speeches can include anything from changes in interest rates, discussion on economic growth, to monetary policy announcements outlining current and future changes. Still on the same, forex analysts and traders take the news and try to dissect the overall tone and language of the announcement. Central bankers can be viewed as either hawkish or dovish. Central bankers are usually described as hawkish when they are in support of the raising interest rates to fight inflation, even in the detriment of economic growth and employment. Dovish central bankers, on the other hand, they generally favor economic growth and employment over tightening interest rates. Economic growth expectations. This usually relates to the economic outlook as held by consumers, businesses, and the governments. It's easy to understand that when consumers perceive a strong economy, they feel happy and safe and they spend more money. Companies with money spend it, and this creates some healthy tax revenue for the government. They jump on board and also start spending money. Now everybody is spending, and this tends to have a positive effect on the economy. Weak economies, on the other hand, are usually accompanied by consumers who aren't spending, businesses which aren't making any money, and aren't spending too, so the government is the only one still spending. And to meet the needs of a growing population, an economy must expand. However, if growth occurs too rapidly, price increases, which outpaces wage advances, hence workers earn more on average, but their actual buying power decreases. If a country releases higher than expected GDP numbers, it means that it has produced more goods and services and will export more. Capital flows. Capital flows measure the amount of money flowing into and out of a country or the country's economy. The most important thing you want to keep track of is capital flow balance, which can either be positive or negative. When a country has a positive capital flow balance, foreign investments coming into the country are greater than the investments heading out of the country. Conversely, a negative capital flow balance is the direct opposite, which means investments leaving the country for some foreign destinations are greater than the investments coming in. With more investment coming into a country, demand increases for that country's currency, as foreign investors have to sell their currency in order to buy the local currency. This demand causes the currency to increase in value. If supply is high for a currency, or rather demand is weak, the currency tends to lose value. If a country also has a growing domestic financial market, well then, even better for the currency. Employment outlook. When it comes to employment levels, they have an immediate impact on economic growth. As unemployment increases, consumer spending falls because jobless workers have less money to spend on non-essentials. An increase in unemployment usually signals a slowdown in the economy and possible devaluation of a country's currency. This is usually because of a declining consumer confidence and lower demand. If demand continues to decline, the currency supplies builds and further exchange rate depreciation is likely. Government present and future. Instability in the current government or changes to current administration can have a direct bearing on that country's economy and even neighboring nations. Political stability has a bearing on the performance of the currency. Risk management in trading. Forex trading has an element of high risk due to frequent and continuous change in exchange rates. One of the fundamental rules of risk management in the forex market is that you should never risk more than you can afford to lose. To minimize the likelihood of financial loss, traders need to have in place some forex risk management actions and strategies. 1. Trading with stop losses. Trading without a stop loss is similar to driving a car with no brakes at maximum speed. And once you've set your stop loss, you should never bring it down. The trend is your friend. If you are a position trader with plans to hold that position for an extended period of time, no matter which position you have ultimately decided to take, you should never fight the current market. Using correct lot sizes. When it comes to initially determining your lot size, it's best for new traders to start small, and you should never risk more than 2% per trade. As illustrated on the table below, a trade that has one lot size and a total account of 20,000 USD, when you're doing a 2% risk on that account, you'd be risking $400. On an account that has the same amount of money and the same lot size of 1, when you do a risk of 10% on each trade, you'd be risking $2,000. This can also be seen on the example where you have a lot size of 10 and 19 as shown on the table. For each, when you have a risk on 2%, we have a lower amount that you're risking in the market. But when you have a 10% risk on each trade, the amount doubles up and gets higher. When it comes to initially determining your lot size, it's best for new traders to start small. Tracking overall exposure. While using reduced lot size is a good thing, opening multiple lots with correlated currency pairs could eventually cripple you. For example, if you go short on the Euro USD and long on the USD Swiss franc, you're essentially exposed 2 times to the US dollar. And if the USD tumbles, you'll suffer a double loss. But keeping your overall exposure limited can reduce your risk and increase your prospect for long-term success. Risk to reward ratio. As a trader, to enhance your chances of growth, you want to trade when you have the potential to make 3 times more than you're risking. This enables one to continuously grow the account even when you only make profit on just 50% of the trades. If you were to reduce your position size, then you could widen your stop loss to maintain your desired risk to reward ratio. Risk to reward ratios are not cast on stone. They must be adjusted depending on the time frame, trading environment, and your entry and exit points. Trade plan. A trading plan defines what is supposed to be done, why, when, and how. This covers your trader personality, personal expectations, risk management rules, and the trading systems. A trading plan usually helps limit trading mistakes and minimize your losses, since emotions can consume you when your money is on the line. It also helps you eliminate any bad decision making in the heat of the moment. And that brings us to the end of our webinar. Thank you for being our audience.